We're starting off with a bang, as SpaceX has just pulled off the largest IPO in history, raising $85.7 billion. But what is even more interesting is how this IPO could be a win for Robinhood Markets. As we've seen, retail investors had access to SpaceX shares through several channels, including Robinhood, which allowed users to invest with no minimum account size. This move reinforced Robinhood's pitch of democratizing access to major IPOs. According to recent reports, Robinhood had strong momentum before the SpaceX IPO, with 27.7 million funded customers and $377 billion in customer assets on its platform at the end of May 2026. The company also saw a significant increase in stock trading volume, which rose 75% year-over-year to $315 billion. But here's the thing. Robinhood's opportunity goes beyond just the cash tied to IPO orders. The company's IPO access policy incentivizes customers to keep their shares and account active for at least the first month, which could lead to more engagement and potentially even more deposits. And with Robinhood's expansion into retirement, banking, credit cards, advisory referrals, futures, crypto, and AI tools, the company is well positioned to win a larger share of each customer's investable assets. Now, some analysts are predicting that Robinhood's stock could see an upside of approximately 30% based on recent price targets. However, it's essential to remember that the market can be unpredictable, and investors should always do their own research before making any investment decisions. We'll be keeping a close eye on how this story develops and exploring more topics from the world of stocks and finance. We'll also be discussing the potential implications of the SpaceX IPO on the broader market and what it could mean for investors. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and market trends. The first one revolves around Chris, an investor who is trying to navigate the complex landscape of AI-generated content. But now, let's shift gears and explore the latest developments in the financial markets. It seems that investors are keeping a close eye on various factors that could impact market direction. The June monthly derivatives expiry is just around the corner, and quarterly portfolio rebalancing by institutional investors is expected to lead to heightened volatility. Additionally, auto sales data for June will be released soon, providing insights into demand momentum after the onset of the monsoon. Foreign institutional investor activity is also being closely watched, as selling pressure has shown signs of easing in recent sessions. The progress and distribution of the southwest monsoon remain on investors' radar, given its implications for rural demand, inflation, and agricultural output. Global variables like crude oil prices and U.S. bond yields will continue to influence market sentiment. With crude prices retreating sharply from recent highs, this could be a positive sign for India, easing inflationary pressures and improving the current account position. As we navigate these complex market trends, it's essential to stay informed and up to date on the latest developments. Technical analysis suggests that the Nifty faces a strong hurdle around 24,200 mark, while the Bank Nifty continues to outperform. We'll be keeping a close eye on these factors and more as the market continues to evolve. Remember to always do your own research and consult with a financial advisor before making any investment decisions. Welcome back to the Riskwiser Zone. Today, we've been exploring the world of investing and navigating the risks that come with it. As we close out the show, let's take a look at what's been happening in the tech sector, specifically with AI chip stocks. We've seen a significant sell-off in recent days, with some of the biggest players in the industry taking a hit. Nvidia, ON Semiconductor, and Intel have all been affected, but to varying degrees. Nvidia, for example, has seen its stock price slip back towards $190, despite reporting an 85% year-over-year revenue jump in its latest quarter. ON Semiconductor, on the other hand, got hammered after announcing a $7 billion all-stock deal to buy Synaptics. The acquisition is meant to push the company deeper into edge AI and physical AI, but investors seem to be balking at the price and integration risk. Intel, meanwhile, has been the sector's great turnaround story, with its stock price rocketing from a 52-week low near $19 to a high above $141 over the past year. However, the company is still only profitable on a non-GAAP basis, and its foundry operation lost $2.4 billion in the latest quarter. So, what does this mean for investors? Well, it's clear that the AI chip sector is highly volatile, and even the biggest players are not immune to market fluctuations. However, it's also worth noting that these companies are still growing rapidly, and their products are increasingly in demand. As always, it's essential to approach investing with caution and do your own research before making any decisions. It's crucial to consider multiple perspectives and not get caught up in the hype or panic. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.